Welcome back to the AI VLX stream for Tuesday, June 9th pre-market. I'm Alex, joined by Ivy. The headline index looks calm, just one new short-term low, but if you dig deeper, 102 stocks are making fresh immediate lows. Ivy, how can the market look so stable on the surface while so many names are quietly breaking down?
Alex, this is a textbook case of the headline index masking real stress. The deeper trend structure is solid, but immediate participation is weak. What's driving the split? Investors are de-risking, moving out of tech, commodities, and emerging markets. Areas like Adobe and JD.com are under pressure, while rotating into more defensive sectors.
So, is this a risk-off environment, or just a rotation out of the usual growth leaders?
It's not a wholesale risk-off, but it's a defensive rotation. The character of leadership has shifted. Healthcare, managed care, and select industrials are leading. Think United Health and Old Dominion. These are stable, cash-generative names, not speculative growth plays. That's a clear sign investors are prioritizing reliability over upside.
Why does it matter if defensive groups are leading? Isn't leadership just leadership?
Not all leadership is created equal. When the market's strength comes from defensive sectors, it signals investors are worried about global growth and want earnings stability. It's a warning that risk appetite is cautious, and the rally lacks the broad participation you'd want for a sustainable move higher.
What's actually being sold here? Is it just tech, or is the weakness broader?
It's broader than just tech. Software, global cyclicals, and commodities are all seeing active selling. Names like Salesforce and Albemarle are making immediate lows. There's also pressure in China and emerging markets. So, while the index looks fine, a lot of global growth sensitivity is being taken off the table.
For headline index, or index-only investors, what are they missing by just watching the surface?
They're missing the fact that the average stock is lagging. The index is being propped up by a handful of defensive leaders, but participation is still weak. If that narrow leadership falters, the headline index could move lower much faster than people expect.
Is there a case for stabilization here, or is this just the start of a bigger unwind?
There's a credible counterargument. Immediate new lows have dropped sharply from yesterday, and short-term support is still strong. If we see new highs start to outnumber new lows, or if tech and cyclical stabilize, participation could broaden out and the market could regain its footing.
What's the surprise risk that could catch index-only investors off guard?
The real risk is that if the quality of leadership narrows even further and defensive groups can't keep the index afloat, we could see a sharp move lower. The market looks stable, but the foundation is thinner than it appears.
So, bottom line.
Short-term support is intact, but weak participation and defensive leadership mean the market stability is more fragile than the index suggests.
Follow AI VLX on X, StockTwits, and YouTube, and check back for our daily pre-market podcasts and weekend updates.